Hello and welcome to the Retire to a Life You Love podcast with your host, Michelle Gessner. I'm Wendy McConnell. Hey, Michelle, how are you?
I'm good, Wendy. How are you doing?
I'm good. I feel like I haven't seen you in forever.
Yeah, well, it's busy summer.
I know it is. And we're in the heat, the dog days right now in August.
We're in the thick of it here in Houston. Oh, my gosh.
I can't even imagine. So what are we going to be talking about today?
Well, we just had a very big piece of tax legislation that just passed in July, on the 4th of July, as a matter of fact. And today, I want to try to break it down for people so they cut through all of there's a lot, right? And you want to know what you need to know. So I thought we would do an episode just on that.
Okay. So we're going to try and break it down and figure out what it means for each person, for us.
That's right. Now, I have to say, this is a 900-page piece of legislation. So I am absolutely not going to go through all of the things that are in this bill.
Have you?
I am, well, and I haven't gone through it. I'm not going to do it. I'm not doing it, and I'm not talking about everything. So definitely not an exhaustive list. But what I do want to do is cover about 8 items that I think are most relevant to most people.
All right, let's get started.
Oh, that was a big sigh, Wendy.
I love taxes. Yeah.
I know you don't. So hopefully I'll make this somewhat bearable to get through. But
you always do.
You've got to know the rules. How do you, if you don't know the rules, you can't make them work for you. So that's what this is about.
Exactly. How to take advantage.
That's right. Now, this bill, the one big beautiful bill, some people like to call it the one big ugly bill. It is a very controversial bill. Some people love it. Some people hate it. So what I'm going to do, we're not going to talk about the politics behind the bill and whether you like it or don't like it. What we're going to talk about is what you need to know.
Okay.
And the first thing I want to say is that many of the changes that I'm going to be talking about are temporary. They go away after the year 2028. So don't get too used to whatever I'm going to tell you here, because it's going to go away after 2028.
But you can plan knowing that too.
Correct.
Right.
And maybe some things that I'm going to mention today are in your favor and you're going to love it. And that's great. And so take advantage while you can.
Exactly.
But they are, I want that understood that they're temporary.
Okay.
All right. So I'm going to start with the simplest of the topics related to this bill, and that is the standard deduction. So the standard deduction got higher right this year. So effective this year, your standard deduction is now higher. So for married people, married filing jointly, it used to be $30,000. Now it's $31,500. And for single filers, it was $15,000. Now it's $15,750. So right off the bat, that helps people who take the standard deduction. Most people do, since it's so high. So that can be a tax savings for most of our listeners.
Okay.
Now, they say that's going to be here to stay, that's not temporary. And the tax brackets also, no changes there. Those are, the ones that passed in 2018, those are
still in effect. Yeah.
Correct.
Okay.
All right. Now, the SALT cap. So that's that state and local tax cap. And for people who live in a high state income tax state, like I think you do.
Yes, New Jersey, yes.
Yeah. So I live in Texas. We don't have state income tax, so we don't care about that, but we have very high property tax. So that SALT cap that was $10,000 has now quadrupled to be $40,000.
Okay.
So if you are an itemizer, if you don't take the standard deduction, you like to itemize, you can itemize and take your state and local tax deduction all the way up to $40,000. So for people who have high property tax or high state income tax, that's a huge advantage.
Well, and it's really beneficial because a lot of people where I live have second homes. They're vacation homes, and when they capped it at $10,000, it really kind of cut them off a little bit. So this is good news.
Very good news. Now remember, it's going to sunset after 2028.
Okay.
So just letting you know, don't get too used to it.
Right. And I have to tell you, I'm so glad that you defined what salt was, because I hear people talk about salt. I'm like, what is salt? And state and local taxes.
That's right. That's right. There's something else I want to just point out on that subject is the 40,000 cap is the same for single filers and married filing jointly filers. So that's kind of unfair. It's a little bit of a marriage penalty, right?
Mm-hmm.
It's not per person. So if you're single or you're married, same 40,000.
Okay. Yeah. So what else?
Okay. If you're 65 or older, or you turn 65 this year in 2025, you get a little bit of a break. You get an additional deduction that they're calling the enhanced senior deduction. So in addition to that standard deduction that we were talking about, you get an extra deduction. Now, that's always been the case. People age 65 and older got an extra $1,600 each if they're married filing jointly, or $2,000 for single filers. So I'm talking about on top of that. Now you get up to $6,000 per person on top of that existing 65 plus deduction.
Okay.
Now, people are calling this a Social Security deduction. That's not what it is. It has really nothing to do with whether or not you filed for Social Security. It's if you're 65 or older. You may happen to be on Social Security, but that's not the criterion.
Okay. So if you're already getting, say, the $1,600, right? Mm-hmm. You could be getting now a deduction of $7,600.
Yes, correct. Okay. Now, the reason I hesitated is because there is an AGI limitation. If you're a single filer, the limit is $75,000. So if you, in other words, your adjusted gross income is higher than $75,000, you're a single filer, it's not all or nothing. You're still going to get some of that $6,000, but it's going to be phased out. There's a formula and it starts reducing.
It's like a sliding scale.
Correct.
Yeah. Okay. Got it.
Now, I have done a few tax projections for my clients. And what we like to do is, here's what your tax return would have looked like under the old legislation. Here's what it will probably look like under the new legislation, so they can see how it directly impacted them. And I have a client whose AGI is around 200,000, and they still qualified for about 6,000 on this deduction between the two of them. And another client at 230, and they still qualified for about 2,400. Okay. So there's still some deduction there for you. You just won't get the full amount.
Okay. Understood.
Are you ready for the next one?
Oh, let me have it.
So there is some help for families. The child tax credit was $2,200. Now it's was $2,000. Now it's $2,200. And it's going to start adjusting for inflation starting next year. Then of course there's also a phase out for single filers and married filers. So modified adjusted gross income, if it's over a certain amount, there's a phase out.
Okay.
The other item with regard to help for families is this Trump account. Now, have you heard of this Trump account? Do you know what I'm talking about?
I'm vaguely familiar with it.
Okay. So if you have a baby in the year 2025 through the year 2028, when you apply for the Social Security number for that child, the Trump administration is going to give you a one-time $1,000 contribution to this so-called Trump account. So it's seed money.
Okay.
To start saving for the future. Now, there's some restrictions. The child has to have has to be a U.S. citizen, has to be born in the United States, and has to, I believe, have a parent who is a U.S. citizen. And of course, you can open up your own Trump account, but if you're applying for the Social Security number, they're going to make that $1,000 contribution, one-time contribution, and it has to be during those years.
Okay.
Now, other things to know about this Trump account. It's not the greatest in my view because there's so many restrictions. So here's one. You can't take any withdrawals until the child turns 18. So no withdrawals. The contributions are not tax deductible. They're funded with after-tax money and not tax deductible. The account does grow tax deferred. And once the child turns 18, you can take withdrawals, but they have to be for qualified reasons.
Okay.
What are those qualified reasons? Things like first-time home purchase, higher education, an emergency, things like that. If you don't follow those rules and you take the money out, let's say child turns 18, you take the money out, but not for one of those qualified reasons, you will incur a 10% tax penalty. So it's kind of like an IRA.
Right. That's what I was thinking.
And by the way, I should say up until age 59 and a half, there's this 10% tax penalty. So if you don't take it out for one of those qualified reasons.
Mm-hmm.
The other restriction that you may not like and you want to know about is that you have to invest that money in U.S. stocks, either individual stocks or a U.S. stock ETF that tracks a U.S. stock index, and no bonds or cash. So if you are not that type of investor, maybe you have a lower risk tolerance.
Right.
That's going to be a problem, and this would not be for you. There's less of a restriction. So I compare this to a 529 account, but the 529 account is much less restrictive than this type of account.
The 529 accounts.
Yeah.
What are those?
Oh, well, same thing. You have to use the money for higher education. I don't think there is a first-time home allowance, but higher education, grows tax deferred, funds with after-tax money, but you don't have this investment restriction I just mentioned.
Right.
Also, the contributions, I don't know if I mentioned, you can put contributions of up to $5,000 a year in this so-called Trump account, but you can put a higher contribution amount in a 529. So I'm comparing it to a 529, and I'm saying there's less restrictions with a 529, but who's giving you $1,000 to put in your 529? So I guess, from that standpoint, take the free money.
Okay, so explain to me what a 529 is. I'm not sure I understand.
Oh, a 529 is just another type of account, and they named it after a section 529 in the tax code. And it's just what I was saying. It's an account that you set up that enjoys tax deferred growth and tax free if you use the money strictly for higher education and certain qualified reasons. And I think that was my next item anyway. So
okay.
Let me just, so 529s, they gave a little bit of expansion on the 529 allowances. So it used to be that you could only use 529 money for tuition and books and supplies. But now, they also, I think, expanded it a little bit ago for K through 12 or private school. I don't recall. But now let's talk about what they're doing now. You can also use that money, 529 money, for standardized testing and extra tutoring fees, homeschooling support. So these are new allowances that just got passed with this bill.
Okay.
Also, you can take up to $20,000 per year out of the 529. It used to be $10,000, now it's $20,000. Now, don't ask me how much money you can put in per year because I don't remember and I'd have to go look it up. But I can tell you it's a lot more than $5,000, which is the point I was making with the Trump account. Okay. And also, you can invest it in bonds. You can invest it in money market.
Right.
You don't have all these restrictions that I was just mentioning with the Trump account.
Okay, I got it. So what's next then?
All right. You may have heard about the auto loan interest deduction. Is that on your radar at all?
Yeah.
A little bit.
I just leased a car, so I'm bummed, but go ahead.
So this is only if you buy a new car and it's a loan. So, a lease is not a loan. So it would have to be a new car purchase. You got an auto loan and it's only allowing the interest on that loan to be tax deductible up to $10,000 per year. But, and here's the restriction, you have to purchase a car that has final assembly in the United States.
Oh.
So but there's quite a few. I believe Toyota has final assembly in the United States. And so it's not necessarily an American made car. I think it can be a foreign made car as long as the U.S. final assembly is in the U.S. And there's a list. You can look it up.
Okay.
Again, only through the year 2028 goes into effect this year. Only can be a new car. Final assembly in the U.S. And you can take this deduction even if you are taking the standard deduction. So you don't have to itemize to get it. So that's kind of nice.
Okay.
What's kind of ridiculous to me is they're giving this cap as $10,000. Now, to be clear, you're not getting to deduct your whole loan payment, just the interest.
Right. Kind of like with your mortgage, right?
Yeah. Mm-hmm. But here's the deal. Who's going to ever reach $10,000 in a year? And I'll tell you why I say that. I did the math. You'd have to have a $175,000 loan at a 6.5% interest. That's what I used on a 5-year loan just to come close to that $10,000 for the year. And then that's only the first year because, the loan amortization front loads the interest. And so the interest starts going down. So you're just not going to get through the $10,000 cap.
Right.
Nice to have. Thanks a lot, Congress. Sounds better than it is because, are you going to go out and buy is your loan going to be $175,000?
Right. Yeah. Not my loan.
I don't know too many people who are going to take out a loan for that kind of level of car, but the cap is high.
Yes.
So.
All right. So, depending on the specific, where you get your car is manufactured, that's to take into account. And remember that it's only the interest, not the entire payment that you can take a deduction on.
And only a new car purchase. So if you're buying used, doesn't apply.
Okay.
If you're leasing, doesn't apply.
Mm-hmm. All right.
All right. And again, it's temporary. It's going away. I think everything I said so far is going away except for the standard deduction.
Okay. Good to know.
The perks on overtime and tips, that's another one that people are talking about. So there's some new temporary deductions that you can take that apply to overtime if you get overtime pay. But here's the caveat there. It has to be overtime that's required by the Fair Labor Standards Act. Not overtime that your company is just voluntarily paying you. So for example, let's say your company says, oh, who wants to work Memorial Day? If you work Memorial Day, we'll give you overtime.
Okay.
That isn't a Fair Labor Standards Act requirement. So then you don't get this deduction for that overtime. So I just want to point that out. So how does this work? Well, if you get time and a half for qualified overtime, then you can deduct the halftime portion from your tax return up to $12,500 annually for a single filer and up to $25,000 for a joint filer.
Do both filers have to be in the overtime, making the overtime, or is it just the one person?
Just the one person.
Okay.
Now, if both people have overtime, okay, it's going to apply.
Right.
Yeah. Now, the other thing I want to point out, again, there's an income limitation and it starts phasing out. So for married filing jointly, it's $300,000. And for single filers, it's $150,000.
Okay. So I'm wondering if you can answer a question for me. My husband works a lot of overtime, but he scheduled that overtime. It's scheduled. Mm-hmm. Does that count as what we're talking about?
If the overtime is related to how many hours in the week, so you know how if you hit 40 hours, now it's considered time and a half. That's right. That's fair labor standards provisions.
Okay.
But if it's just, I think we'll just pay overtime, if it's an enticement by the company to work on a particular day or whatever, that's not, they're just doing it. And so it's not that Labor Standards Act. So it wouldn't be qualified for this.
Okay. I think I understand.
I don't know if I answered your question, but.
No, I think you did because, like I said, he's scheduled this and it turns out to be more than 40 hours per week. So I think it falls under that.
I think so too.
Yeah.
But I always like to give the disclaimer on these episodes. I am not a tax advisor or a lawyer. So look it up and get, go to your professional and get the nuances. This is just kind of a, hey, did you know? So you know what questions to ask and how it, applies to you and your personal circumstances. But it sounds like it would.
Yeah, I just want to use you for my own personal use and get all my answers from you.
Now, I do want to point out that it sounds better than it is because there's all these ifs, ands, and buts, right? Another one to consider on this very topic, your pay that is deductible, this half portion, let's say you meet all these provisions and you can deduct it.
Right.
It is still subject to Social Security and Medicare tax.
Okay.
So,
keep that in mind.
Yep. Okay. So also everybody, I'm sure this is well known because it's been in the news, but your credit for electric vehicles, EVs, those are going away after September 20th of this year. And there's an energy efficient home improvement credit that was supposed to be in effect through 2032. And now that ends in December 31st of this year.
Huh.
So if these things apply to you, you were planning to get an electric vehicle, you better hurry. September 20th. By the time this thing is, this episode that we're recording is live, it may be already done. And if you're doing some home improvement, energy efficient items, you might want to get that done this year because those credits also go away.
Okay. Good to know.
Lastly, because I do not want to put my listeners to sleep, and I know this is a very dry topic, but it's good to know how you can benefit with your tax return.
Sure.
Charitable giving has changed. So if this applies to you, if you're someone that likes to give to charity, I think there was a lot of upset or irritation with the fact that, you really couldn't take the standard deduction and get a deduction for charity. So they've changed that. So starting in 2026, there's a new provision for charitable deductions for non-itemizers. So these are people who are taking the standard deduction and they're making cash donations. It has to be cash. So if you're taking clothes to Goodwill, that doesn't count. It has to be cash.
Okay.
So if you're taking the standard deduction and you're making a cash donation, you can do both. You can get deductions for both. But, there's always a but. There's always a restriction. Yeah. So the but is this: it can only be up to $1,000 for single filers and $2,000 for married filing jointly, in addition to the standard deduction. And not only is there a but, there's an and. Here's the and. There's a floor now, just like there is with medical expense deductions. So now, if you want to take this $1,000 deduction or $2,000 deduction, depending on how you file, you also have to qualify for a floor, meaning your adjusted gross income has to be a certain level. So your donations in excess of 0.5% of your adjusted gross income are deductible. In other words, if you're just making a little tiny donation, and that hasn't reached or hasn't exceeded 0.5% of your adjusted gross income, well, then that portion does not count. Only what's in excess of 0.5% of your adjusted gross income. I liken this to the medical deduction. So you know how you can itemize, if you're itemizing and you have a lot of medical expenses, they have to exceed 7% of your adjusted gross income, and only that amount that exceeds you can deduct. Well, it's like that, except it's 0.5%. And you don't have to itemize. You can take the standard deduction and take up to that amount. So I don't know if that really helps people or not.
That's what I was just thinking, because, there are certain charities that I give to monthly. I was thinking, so I add those up at the end of the year. But if it has to be more than it has to be more than a 0.05%.
0.5%.
0.5% of our adjusted gross income.
Yep.
Yeah.
And if the amount that's under 0.5%, you can't deduct that. You only can deduct over the excess.
All right.
And then there's a cap of $1,000. I mean, so, or $2,000 if you're married. So again, I don't know how good this is, but it's there. for you to consider.
Well, and again, it's good to be able to take advantage of it if you can. And keep in mind that, does this have a cap as well? Is this going away?
Is this one going away? I think so. That one, you know what? I don't know. I don't know if it's going away. No, that's okay. I know it starts next year. What I don't know if is if it's temporary. So that one's a good question. Okay. I'll have to follow up on another episode and answer that one.
Okay.
And our listeners can always look that one up too.
Okay.
But the last thing I want to say about charitable donations is there's also another change that would be applicable here. If you fall above the 35% marginal tax bracket, your charitable donation or deduction, I should say, is capped at 35 cents per dollar of income. So you're in the 37% tax bracket. You can only deduct 35 cents per dollar of income. And that starts next year. So if you're listening to this, it's still 2025, and you want to you are planning to make a large charitable donation, you might want to make it this year if you're in a high tax bracket, because you'll get the whole enchilada.
Okay. Yeah. Yeah, there's a lot of numbers in this game. I'm not good with the numbers. That's why I leave it to you.
900 pages, Wendy.
Yeah, I know.
And I just covered a micro, amount of tax information here. But yeah, 900 pages. I don't know who's reading. I don't even think the Congress folks have read the 900 pages.
I think some of them even said, I didn't read it.
So look, the tax folks out there are trying to make sense of all this. And those of us who rely on professional tax advisors to do their tax returns, they're going to help you. They're going to do their professional best. But the reason you need to know is because by the time you get to the tax advisor, the year is over. And if you are just then figuring things out, you might have left some money on the table. So that's why I want to make sure our listeners at least know some of these basics.
Absolutely. All right, Michelle, if people have more questions, and I'm sure they do, how do they get in touch with you?
Yeah. So in my office, we like to do tax projections and help our clients get a grip on this. We're not filing tax returns, but we are doing projections and analysis. You can reach us. Probably the best thing to do is just visit our website, GessnerWealthStrategies.com, and our contact information is right there.
All right. Sounds good. Well, thank you so much, Michelle. We appreciate all of the information. And thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to Retire to a Life You Love with Michelle Gessner from Gessner Wealth Strategies. We hope you were inspired to take steps to your financial freedom as you learned new techniques and strategies for managing your finances. To learn more about how you can improve your financial landscape, visit our website at www.gessnerwealthstrategies.com. That's GESSNER wealthstrategies.com. Or give Michelle and her team a call at 713-589-6448. And don't forget to click the follow button below to be notified when new episodes are available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Michelle Gessner or Gessner Wealth Strategies. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.